Hey everybody, Preston Bryn here with our weekly roundup brought to you by our trader user group. This is for the trading week ending July 20th, 2018. Before I kick off, as you can see, I have the E-mini S&P 500 futures daily chart on the screen in front of you. We saw the week is really kind of a tug of war between earnings and trade tariffs. Earnings seems to be the shiny object right now, but Trump came in the middle of the week and talked about the possibility of taxing all Chinese import goods. But not surprisingly, the markets didn't react too much to it. I think the markets are getting used to some of these Trump tweets, and they're waiting to see the reality of whether they come true or not. So the markets seem to be near-term focusing on earnings at this time. And we saw this past week the Dow actually finished up 20 basis points. That's 0.2%. And it was also up the prior week of 2.3%. So we had a couple of weeks in a row of the Dow steady to slightly up. The S&P was up about 2 basis points, almost flat for the week. Prior week it was up about 1.5%. So we've had a few weeks in a row of the S&P up. Nasdaq actually finished down 7 basis points, 0.07%. Prior week it was up about 1.8%. So net this week was a relatively flat week. That we did see the VIX come up just a little bit. Was up about 5.5% to around finishing the week at 12.86. So basically the week was kind of a flat week with fall still under 13 or under 15. It finished the week at 12.86, as I said. But we still have a lot of geopolitical risk out on the table in front of us. Tremendous amount. The other thing that the market seemed to be focused on is the 2s over 10s. That is the yield curve and the yield spread between the 10-year minus the 2-year. And we've been talking about this. I've been talking about this for our members for the past 6 or 7 months, how it tends to be a recessionary forecasting tool going back to the 50s. We've seen recessions occur just about every time that the yield curves move below zero. I think this time is going to be slightly different. With our members this Sunday night, I'll go into some more details on why that's so. But let me just give you a hint. Right now, there's currently about 9.2 trillion in and this is according to Morgan Stanley, but they've estimated right now total debt globally that's still showing negative interest rates is $9.2 trillion. That has an effect on our yield curve. It tends to flatten our yield curve. It tends to drive down the duration of our further dated treasury debt, more specifically the 30-year. And because the economy and wage growth has been lackluster, but the economy itself has been very strong with earnings growth and everything else, the Feds have hiked the rates. And anytime the Feds start hiking the rates, the short-term duration under 5 years tends to move up at a quicker pace in the back end of the curve. That would be the 10-year or the 30-year specifically. That tends to flatten the curve. What that also shows is that the U.S. and the markets right now are not pricing in very strong growth and earnings outlook for 2019 and 2020. I've seen a number of reports come across my desk from analysts. I've talked to some buddies also in the hedge fund industry that have some worries going out into 2020. But be that as it may, we're more focused on where we are right now and what price action is showing. And if we look at the current chart here, the market is doing pretty much, the price action is playing out pretty much what we had talked about, what I had discussed with our members. You can see here that we've hit what I call this R1 zone, which is a very strong resistance area. As soon as we attempted that breakout, we moved right back into the zone again. I said, generally, from a technical perspective, technical analysis perspective, if you've got a very strong support or resistance point, in this case, this is a resistance point. It was our R1, first level of resistance on this daily chart. If it's a very strong level, if you do have a breakout, you're going to have a retest. So now the key for us, as I said in this retest, is if we break back out again and we take out that prior pivot high on the first breakout, That's going to be a bull run, and we're going to take out 28.7850, which is the all-time highs for the E-minis. That was made back here in January on that huge run that we experienced back at that point in time. Okay. If you guys remember, what really precipitated that big fall off was the 10-year interest rates moving very quick. Not slow and gradual like they're doing now, but very fast over the 3% level. That was the first time we touched the 3% level in a long time on the 10-year. And that precipitated a downward move, and then algos started kicking in. There were a lot of longs in the market with sell stops underneath that accelerated the move. And literally, and this is a daily chart, by the way, in less than about a week and a half, we went from 28.78 down to 25.29. Huge move. And then we had these bounce. We had another retest here about 4 days later, a close retest in this area here, and then we haven't looked back since. Okay. So the markets have shown strong resilience to a lot of the Trump tweets on the trade tariffs. And like I said, longer term, there's only two things that control stock prices or the price of the markets. There's only two things at a macro view. One is earnings per share, and the second is interest rates. And interest rates is really the big gorilla, because depending on where interest rates sit, that determines the flow of money. And not just the flow of money in the US, but the flow of money globally. And because we've got this 9.7 trillion in global debt that has below zero interest rates, and we've never ever had that before in the markets. Okay, we've never had that. It's the first time. That makes the yield curve flatter. It pushes money into the US. It makes the US dollar stronger. Money wants to come here. And the spread between our 10-year yields and other countries' 10-year yields, particularly Europe, especially Germany, the German Bund, is very wide. That forces money into our market. So that gives the US the luxury of having the only pig in the pen with lipstick right now. But that makes it very tenuous. Okay, I would love to see global growth and the global growth story. If you remember 2017, I think every TV talking head was talking about global growth. It's global growth this, global growth that. 2017 was a very unusual year. Volatility never really got outside of 11.5 or 12 to the upside in the VIX. I mean, we've seen near all-time lows in volatility in 2017. Global growth this, global growth that. All of a sudden, in 1 week, right here, the entire mood and the entire sentiment shifted. Now, the only one that's talking about global growth now is those that are referring to the US, and that is fleeting, meaning 2019, 2020, it's going to fall off. And I'm starting to now see analysts come back out and start to come back into this let's invest in emerging markets, because they've had a big hit since February. So it's going to be really interesting for our members. We'll spend more detail on it this Sunday evening, but that's what I'm looking at in the markets right now. I am watching to see whether we have, with this retest, we're currently back in the R1, whether we move up or we chop here. Now, should we fall back down again, it's going to be more bearish. You can see down here, I have the MACD crossing back to the downside. That would suggest there's still a little bit more pressure to the downside than to the upside, right, as we start next week. And remember, we're getting into the thick of earnings next week. We're going to get Google coming out on Monday, I believe, after markets close on Monday. We're going to get Facebook on Wednesday. We'll get Boeing, which will be a good indicator of how the trade tariffs are going to affect these things on Wednesday. We're going to get some GDP information next week. We get ECB, central bank information next week. So it's going to be a very interesting week, and that is going to really determine which cycle we're going to move into. All right. The markets tend to suggest we're not going to get escape velocity just yet to get up to 28.78. Now, where do I think the markets can go for the rest of the year? The charts would seem to indicate that we will take out these 2018 highs, but we're not going to get much further than that, okay? And the wild card in this, as I said last week, the wild card in the poker card deck, the Joker's wild, is Trump. If we execute these trade tariffs, then globally all markets are going to suffer. And you're going to see the US suffer a pretty good little bit also. But the markets right now are banking on the fact that he's not going to do it. I don't think it's a bluff. I really believe if China stands firm, Trump is going to be pushed into the corner of standing firm. And then we got the midterm elections coming up. So it's going to be really interesting to see how this plays out. I think it's probably not going to happen before the midterms. And the markets kind of support that theory. Otherwise, we would be down below the February lows of 25.29 right now. But understand, folks, we can get down there in just a few days, a few very bad days. In a 3 days time, we move from 28.29 down to 25.29 in just 3 days. All right. That shows you how fast this market can move. 3 days. By Wednesday, we could be down to 25.29. Now, I am not saying that's going to happen, but I'm saying that's how fast it could happen. So you must be hedged in this market, and you must be quick to take profits. And a lot of our options trades for our members were shifting to long gamma and long vega. I think the bigger play with volatility is more up and more long than short. I think selling here, the only interest for me in possibly selling would be in the 28.78 strike. I would be up or north of 29.50. That's where I would sell, right? I would sell in that area north of 2900, 2950 strike. I would be more willing to force the market to force me out of the position. I would not be selling underneath at this point in time. Okay, I don't see that as a viable strategy at this point, because you could wake up one day and in 2 days you're so far underwater that you've lost 10x of what the premium you were taking in. So that's a little bit about what I'm seeing here now. If we look at the Nasdaq, it's the strongest index. You can see we're near all-time highs. It looks like a little bit of a bear flag. We've got a little bit of a downturn in the MACD. It is a bearish divergence. It's not what we would call a poor man's bed. That would suggest we got more downside action near term in the Nasdaq. If we look at the Russell futures right here, you can see here we do not have a bearish divergence. We have what we call a poor man's bed, poor man's bearish divergence. That would suggest a little bit of a weakening in price here. Although the Nasdaq held up stronger than most towards the end of this week. You can see the subsloping trend line. We have both on the Nasdaq and the Russell futures upward vectors on the trend line and the 50 and the 200 EMA, and we're north of both. So to me, I would treat this more as a possible dip action than anything else on Nasdaq and the Russell. Now, if we look at the Dow, remember the Dow reclaimed the 2018 opening price. So it reclaimed the green, as I said it would to our members, and I was suggesting to our members back here in early July, before July the 4th, that we were looking at possibly going long. And when we crossed the MACD to the upside, actually the long trigger was right around the 3rd, coming back from the 4th and those holidays. That would have been a good long position. And we did that. We took longs in the Dow futures. We retook the 2018 open price. We moved up. You can see here that long candle on Friday. That's a bullish candle right here. If I just blow this up so you can see it here very well. You can see on this candle right here that we came in and we came all the way down here on Friday, and then it closed in the upper range, the upper band. That would tend to indicate that there are buyers down in this area here, in this wider S1 support zone, of which the opening price is in the middle of it right here. Okay, so that would suggest that any retest here in the near term is going to be bought. This is all going to change if tariffs come to be, because the Dow is most affected by the tariffs, more so than Nasdaq, and the least affected would be the Russell. All right, but this just shows you the confluence of the market. Also, let's look at the Dow transports. The Dow transports are just barely above the 2018 open price, not performing as well as the Dow. The Dow is outperforming the transports. So we're watching the transports. You can see this volume over price. There's two main resistance areas. We're in the R1 zone right now. We haven't been able to get escape velocity north of it. And there's the S1 zone sitting just north of the 200 EMA. All right, so we're watching the transports to see exactly how this thing is going to fare. Now, if we go over to the emerging markets, if we look at China, China's ugly, guys. I mean, you can see here from the peak to the trough, it fell 27.98%. So call it 28%. We're sitting here right now on a close of 26.14. So we're still down dramatically from the peak. And from the 2018 open price, we're still down a really good bit. China is going to be hurt dramatically by the tariffs. So we just have to watch China. And then, of course, if we look at the Vanguard All World Index, again, look at the 2018 open price, the All World Index. The rest of the planet's not doing that good. US is the only pig in the pen with lipstick right now. You can see the 50 and this death cross actually crossed the 200 EMA. Okay, now it's a lagging indicator, but it's an indicator nonetheless. Generally, when I see the 50 cross the 200, you'll have price action because it's lagging. You'll have a bounce to that location. So if I were to extend a line out like this, you could have a bounce up here, and then you're going to experience a lot of what we would consider the R1 resistance level, and then we're going to come right back down again. Okay, that would suggest we got some more run to the upside in emerging markets and all of these other things, but it's still, to me, very concerning where we're looking across the planet right now. And then, of course, if we look at emerging markets, speaking of emerging markets, you can see here we're well below the 2018 open price. You can see we're nearer the 2018 open price. So again, we've got a lot of volume over price sitting right up here at 46.30. So I could see a little bit more of a lift in price, but we've got a lot of resistance up here to get through. So emerging markets are not looking that good right now. One of the primary culprits of emerging markets, of course, is the stronger dollar. You can see the dollar Friday had a really strong move lower. And you can see here that we actually made a new all-time high on the dollar on Thursday. Then Trump came out and did his press conference, and he started complaining about the Feds and rate hikes, which surprisingly, in a Machiavellian way, the dollar sold off because the markets interpreted that as a contrarian indicator, meaning the Feds are going to do everything they can to show independence from Trump. So if Trump says raise rates, the markets interpret that as the Feds are going to lower rates. And because Trump came out and said, let's keep rates low, the markets interpreted that as, well, then the Feds are probably going to raise rates. And that, in turn, spooked bonds. It spooked all sorts of things. And it had an impact on the dollar as well. All right. We've been in this range here for quite some time. I think the near term is just chopped for the dollar. If we look at the euro, I've never been a believer in the euro experiment. You can see the euro here. I've called for the euro to come down to about 114.6, 1.146. We're in this range right here. We've been in it. To be honest, we've been in this range since May. So about 2 months sitting in this range. We're going to break out. I think the odds right now here favor a breakout to the downside, but we're up near the upper boundary here. Now we're going to get movement with Super Mario Draghi speaking this week and what the ECB is looking at for interest rates and stimulus. Remember, they're still doing stimulus. So's Great Britain, so's Japan. China in their own Machiavellian way is doing stimulus, right, by extending or reducing the bank loan reserve requirements, of which most of the banks have government ownership anyway. So I don't know, So you can see right here that should Super Mario, come out with more of a hawkish statement, you're going to see the euro go up, you're going to see the dollar go down, and you're going to see emerging markets go up. All right. So emerging markets are going to follow the euro, really. And then you're going to see the bond market probably stay steady, maybe slightly down. We'll see. But that's kind of what I'm looking at this week. We got these ranges that we've been in for a while. Choppy, yes, but we haven't really had a clear winner and a clear loser. Okay. Um, but speaking of losers, the British pound has been suffering. If we go back, for our members, we've been long the British pound. We've been using this channel guide here to time our long purchases, profit taking, and so forth. When we were up in this area here, I was really pounding the table. This is not the time to go long the pound. Let it pull back into the channel, and we would go long. Well, on this move right here, it pulled back into the channel. And this move right here back into the channel, it didn't fall deep enough, so I was not really a bull right in this area here. I said, let's let it come down. It didn't, and it took off, and I said, okay, it's going to come back into the channel. When it got into the middle of the channel here, we never did get a bullish signal. It just kept going lower. When it hit the bottom of the channel, I said, okay, the expectations favor a bullish signal to go long. It didn't do it. It kept going lower. The minute we broke out of the channel, all of our long macro trade in long the British pound was out the door, right? On this daily chart, again, you can see the 50 EMA crossing the 200 EMA. That sets a level, a R1 level for resistance to the upside. So if we have a British pound moving up, I'd be now more inclined to sell it rather than going long. Our shift, our macro theme has changed more to the downside, at least for the next 90 days, unless we get different word from the Bank of England. So we're going to see how this thing shakes itself out. Okay. If we look at the yen, which tends to be a flight to safety in a global market that shows a lot of agita, I think the yen has gotten overextended to the downside. We came close to the 2018 low. I think you can also see here on the daily chart, we have a cross in the 50 and the 200 as well. So that would make this the upper boundary for the yen and then a possible rollover again. So that's kind of where I'm looking at for the yen. And if we look at the bond market, well, it came down hard on Friday. It's sitting just below the 50 EMA. Every time the bonds comes into our R1 resistance zone, especially at the top of the zone, you want to be more a seller of bonds than a buyer. Okay. And that's been true going all the way back to actually coming back to February of this year, almost for the entire year. My support area for the bond market is down here. Now, should that area break, let me go out to a weekly chart. If this area breaks, bonds are going to get really ugly. All right. That has been my support level for bonds for quite some time. In fact, I had that support level on back in April timeframe. I said that's where bonds are going to go, and that's almost exactly where they did go. And you can see that big volume over price right here, just north of this. So we're almost at on a weekly basis, a parity value for bonds based on bulls and bears. Now, if I take it out in time, the next level down is down around 132. All right. And that is another parity level going all the way back to 2012. Okay. We're at a very big one right here, but then it falls off very sharply here, and then it comes back up right here. So, if we break this area here, it's going to fall very rapidly. All right. Now, what's going to cause it to break? In my mind, the biggest thing that's going to drive our interest rates is not the US Fed, believe it or not. What's going to drive our interest rates is Europe and the ECB and Super Mario Draghi. If he comes out and he says we're going to be pulling stimulus and we're going to show more hawkish tunes, you're going to see the bonds go down. And by the same token, you're going to see interest rates here come back up and challenge the 2018 high. Should we break the 2018 high, then that's going to start a cascading effect in our U.S. equity market. So these are things that I'm going to be watching with our members, and we're going to set up some really good trades that I think that can take this and convert it into some profits for us. Okay, let's look at oil for a second. I saw a report in Barron's this weekend that said oil is going over $100 a barrel. I've seen other reports that say oil is coming back into the 40s. Who's right? Who's wrong? To be honest with you, I don't know. Oil is in one of these crazy tug of wars between geopolitical politics and supply and demand. Eventually, supply and demand will win out, but geopolitical politics are playing a role in crafting supply and demand. So they're almost tightly interlaced. Whether Trump grants amnesty to a lot of countries buying oil from Iran, or he does not grant them an extension and forces them to buy oil elsewhere, and just how much he shuts down Iran. That's more oil off the markets. And then you've got Venezuela with oil off the markets. Fortunately, we're seeing Libya and Nigeria come back online a little bit, and the outage in Canada looks like it's going to be shoring up the end of this month into August. So that'll put a little bit more oil online. Meanwhile, we got our oil projected to go over 11 million barrels a day. By the way, that's more than Saudi Arabia and more than Russia right now. So we've got a lot of push-pull going on in the oil market. So I think there's going to be more chop until we start to get a clearer picture of how this is going to sort itself out. Until it sorts itself out, you're going to have these big, wide dips, counter trends, and trends. Keep in mind the overall trend is still up. All right. I mean, the overall trend line right here, coming all the way back to June, is still up. So if I were to put that trend line on just like that, you can see here roughly the same vector. I've got these two trend lines and we're parroting it. Now, if we break this trend line, we're going to come down and test the 50 and the 200, which are converging right between an R1 and an R2 support point. So near term, we could see a little bit more downward move in oil, but I think it's going to be choppy until we get a little bit more clarity around these geopolitical events, which are controlling supply. Demand, you can't control. It's based on the economy. As long as the economy is relatively strong, you're going to have the demand. But the supply side of the equation is what's causing the issues here in the agenda right now. Okay. And if we look at Brent oil, this is Brent. And you can see here with Brent, well, actually, what this is, folks, this is the yield curve between Brent and WTI. And you can see now we're down. The 5-year average is around $5. You can see Brent has come down dramatically versus the spread between Brent and WTI. I think this could eventually go negative. We're at a value area right here, okay? But this could eventually go negative. It's been negative before. We traded the spread between Brent and WTI back here in June, and we made some money on it. It was a good trade. It got really overextended right here. But, and if we look at Brent oil itself, let me find it here. Here is Brent oil. You can see Brent is also bouncing off the highs here. You can see the 50 getting ready to take over the 200 to the upside. So we still have an uptrend. And that is if we measure the trend line, you can see it just like this. I mean, we go slightly below it, but we're closing right on the trend line. Should it break, I think we get a little bit more downside in both Brent and WTI. But I think it's going to be choppy until the geopolitical events help balance out the supply versus demand issue. Okay. If we go look at metals and look at gold, this is doing exactly, guys, what I've been telling you for the past 6 months. Gold is more of a short than a long. This is a weekly chart. This is a bullish, this is a hammer candle. This is bullish on the weekly chart. Now, if we come into daily, you'll see the bounce off the low here, right? I think we're going to run up a little bit, but we're not going to get up above 1250, 1260, and then the odds favor a rollback over again. If we clear that range, which roughly is around this area right here, we can clear that range around 1262, then I think we'll run up a little bit more. But this has clearly been a short. I'm looking at the possibility of a short-term bullish divergence here, not a poor man's bud, but a bud nonetheless. And you can see the 50 crossing the 200 right here. So remember what I said, at the cross of the 50 and the 200, it tends to act like a magnet for prices to come into that point from a counter trend perspective. So that would suggest gold near term over the next 30 days could move a little bit higher. And the same can be said for silver. Okay, I've got a long-term trade on in silver. That would suggest silver. Now look at silver. It's fundamentally weaker than gold because if you look at let me just show you how far back do we go here. If you look at the chart, you can see here, which is unusual. We've had the 50 go below the 200, go above, and go back low. The last time the 50 went below the 200 was right back here in September of 2017, and the 50 EMA has been below the 200 since, which suggests downward pressure on silver, even though we've had these spikes to the upside. I've got a couple of different symmetrical triangles on here. Both of them, however, suggested a break to the downside, coming down and testing this 1500 psychological level for silver. Short term, I think we can get a little bit of a bounce up. Longer term, I think it'll sell back off again. Okay. In the ag market, for our members, I will go through what we're doing in the ags and the opportunities that we have here. Okay. Meanwhile, for everybody else, if you're not a member of our group, I highly encourage you to come in, check us out. I've got a super offer that's always associated with our weekly roundups. I hope you take us up on it. We've having a lot of fun, doing well in 2018. I think 2018, as we go through the end of the year in 2019, is going to offer up even more surprises than we've seen so far. And I mean surprises, things that aren't expected. And we're going to want to stand in front of them and take advantage of them. All right, everybody, have a great weekend, and I will talk to you guys next week on our weekly roundup. Members, I will see you this Sunday night for our weekly market watch. Take care, folks. Ciao.